Hi, investors. Welcome, everyone. We are so excited to share our April market update presentation with you all. I'm Destiny Fernandez, the marketing manager at Catalyst Funding. And before we dive in, I want to remind you that the webinar is being recorded. You'll be sent a copy via email tomorrow. If you have any questions for our amazing speakers, please write them in the question box. We'll answer those at the end of the call. And don't forget, one lucky winner on the call today will receive half off their next hard money processing fee with Catalyst Funding. We will announce the winner just at the end before we open for questions. As always, we love providing this webinar as a tool for you to assist you in assessing the current and future market. However, we do want to note that Catalyst and our associates or our guests are not liable for any investment decisions you make hereafter. Please always conduct your own due diligence before moving forward with a deal, and feel free to contact us to speak directly with one of our fully licensed loan officers if you have a specific deal in mind that you might want some feedback on. And if this is your first time joining us today, let me introduce you to our two speakers. We have our founder and CEO, Wade Comeaux. Wade started his career in 1995. He's an active real estate investor and a licensed real estate agent who's not only going to be sharing from the perspective of owning a lending company, but also from his personal experience as well, and the rental portfolio we have in-house. So make sure that you ask questions for Wade because he is a wealth of knowledge. Next, we have our Director of Lending, Jeff Johnson. Jeff handles all of our lending operations at Catalyst and aims to provide our clients with the best and most excellent, smooth transactions that we can. He is also coming to us with a wealth of knowledge and 20 years of experience. Hey guys, welcome. Before we introduce our special guest speaker, which I'm so excited for you guys to be meeting and hear from today, I want Wade to tell you a little bit more about us, especially if it's the first time that you're joining us. Wade, feel free.
Thank you, Destiny. Yes, tell you a little bit about the value we try to provide as a company, and we are really passionate about being a one-stop shop for all your hard money and permanent financing needs. Hard money is the money to purchase and repair distressed real estate. And as you know, often the best deals out there are going to be distressed properties because you can differentiate yourself from traditional buyers, and we help you buy those properties and then also repair them. And we really care about also being the fact that we're built by real estate investors. As Destiny mentioned, our team has a lot of experience. Many of our newest and youngest employees also invest in real estate and hold rental properties, so it's something that we really believe in as a company. We've been involved in thousands of transactions over the years, and we provide a single point of contact for all the different loan products that you would want. So you have one loan officer for hard money, permanent financing, non-qualified mortgages, qualified mortgages, the entire gamut. And then we also have a 5-star customer service rating on all social media platforms, including Facebook and Google. And we offer primary refi, purchase, and cash out. So a lot of our customers right now are still taking advantage of the interest rates while they are lower to fuel their real estate investment goals. And while rates have gone up, they're still historically low. And this can be a great way for you to invest in real estate or in other areas that you may feel are good investments at this time. Our hard money interest rates start as low as 6.99% and 2 points. We also have a special VIP flip program for experienced flippers with very low interest rates compared to the market, and as low as 9.99 with only 1 point in some circumstances. And then we also have best-in-class pricing on non-QM loans as well. Those are no longer in the low 5s. I guess we didn't get to update this. Interest rates have really gone up. That is actually in the upper 5s at this point, or low 6s. And then we have a very new exciting program. It's an Airbnb for conforming loans, where actually it does not have to have previously been an Airbnb in order to qualify for this product. We can actually use comparable Airbnb sales in the area, and we have a way in which to do that in a more efficient manner. So if you've ever considered getting into that space, which is a very exciting space, growing very quickly, and then also we've seen information that says that the average short-term rental is earning 61% more than the average long-term rental. So it provides a real significant cash flow opportunity for you. So if you want to talk with our team about that, we'd love to hear from you. I'll turn it back to you, Destiny. Thanks.
Awesome, thanks, Wade. And we do have a slide on that at the very end, that brand new product. We are just starting to roll it out and start talking about it. So you guys are hearing it first. First come, not first serve, but jump in on it while you can. We'll cover that a little bit more towards the end as well. And lastly, and certainly not least, I want to introduce you to our special guest, Jennifer Wauhob. She's a hard chair and a team leader for Better Homes and Gardens Gary Green. She will also be sharing from her impressive 11 years of experience as a licensed realtor who is dedicated to helping families in Katy and West Houston area. She was named top 20 under 40 Rising Star in Houston in the real estate by Houston Association of Realtors in 2014. She was also named 11 Realtors to Watch in 2017 by the Texas Association of Realtors. Texas Magazine titled her as a 5-star realtor 5 years in a row, and she is a Platinum Award recipient for Better Homes and Gardens, ranking her in the top 1% of agents in the national brand. If that's not impressive enough, she's also been a regular guest on KHOU 26 News, NPR, and ABC 13, as well as a featured writer on Realtor.com. Jennifer, we're so excited to have you. Please take the floor.
Thank you guys for having me. I always say I highly recommend that you write out a bio and then make somebody read it back to you. You know, it's just good for if you're having a bad day. I try to get my kids to read my bio and no such luck. But yes, like Destiny said, I am in residential real estate sales. I run a team of 7. We're out based in Katy, but we kind of service the entire Northwest and South Houston areas. I have 4 licensed agents on my team. I have 3 support staff. I'm hoping to really grow this year, actually, because our business has really been growing. And in addition to selling real estate, I also serve as the chair of the board for the Houston Association of Realtors. So that is the largest trade association in Houston. We have 47,000 members. And so in that role, working on basically everything real estate related in Houston, our MLS, legislative stuff, working with our elected officials on anything that might affect real estate, technology, rules for agents, looking at what's going on in the market out there, a lot of MLS stats, and just making decisions for our association. So heavily involved in the industry. I also serve for the Texas Association of Realtors as a regional vice president, and I serve on the board of directors for the National Association of Realtors. So safe to say this is kind of something I'm passionate about. I'm really looking forward to speaking with you guys today. I'm really excited to hear about your Airbnb thing, because I'm having a lot of clients who are wanting to purchase properties for Airbnb purposes or VRBO. So excited to hear from you guys as well and throw in my 2 cents. So thanks for having me.
Awesome. Thanks for hopping on. I'm curious, I saw on there in your bio, with the pandemic, and I'm sure a lot of people started listening to a lot more podcasts. So what was the NPR topic you were talking about on there?
I get asked to speak pretty frequently, typically on what's market updates, what's going on in the market, kind of what we're talking about today. So especially over the course of the last 2 years with things being, I don't like to say crazy. I like to say it's a complicated market. You know, you need somebody who's seasoned and knows what they're doing on your side to advise you. But a lot of media outlets reach out because they want to know what's going on, what's our inventory at, what advice do you have for buyers in this competitive multiple offer type market? What advice do you have for sellers who want to sell their home but they don't necessarily know where to go? So typically talking about that sort of thing. I love doing radio because you don't have to put on makeup. NPR is great.
Awesome, Jennifer. Well, we are excited and we're ready to jump in. So I will pass the torch over to Jeff.
Okay, so this is a chart that we do on all of our updates. It shows the housing starts from the last, I guess, what is that, 60 years? And we always point to the fact that one of the big reasons why we're in this situation with the lack of inventory is starting about 2010, where the chart bottoms out for the last 10 years. Those are the number of housing starts that we've had. So it is the lowest 10-year period we've ever had. Well, I guess I don't know how far back it goes, but certainly as far back as this chart, which goes all the way back to the 1950s. But it is the lowest 10-year period we've ever had, the 2010s. That coupled with the population growth will it's a good foundation as to why we are seeing such a low shortage. Now, I am happy to see that it's significantly on the rise, and hopefully it keeps going that way. But for now, it's a great indicator as to why we're seeing the shortage of inventory that we have today.
Yeah, I was looking at the U.S. population in 1960 as an example, when it looks like the housing starts were comparable. If you take the 60s there, looks like there were more housing starts at that time than this last decade. And the U.S. population was 179 million at that point. Now it's close to 340, right? So it's a very big difference without more homes being built. So I hear a lot of people saying they because of higher interest rates that they anticipate, maybe some market shock, maybe even price depreciation. And interest rates are going to affect it. We're already seeing slowness compared to where we were before, but we're coming off historic highs. So I think in the absence of more inventory, even with higher rates, there's still going to be a bit of a housing challenge because there are just really not enough homes right now.
Yeah, I'll just add to that. I listen to a lot of economists and people who study a lot of this data, and they kind of pointed out we had been underbuilding for several years before the pandemic started. So then when the pandemic hit and we had this big boom in demand for housing, we weren't ready for it. So it's actually been a long time in the making, this inventory issue that we have right now. And gosh knows we need more homes to sell, that's for sure.
There's no doubt about that. All right, next slide, please. All right, so this was an interesting article in Market Watch talking about the 4 predictions for the housing market in 2022. Prediction 1 was that there may be less competition for higher priced homes. And that is always where pressure hits first. In the past, a lot of real estate investors targeted the lower end of the flip market, right? High enough for flippers to be able to acquire distressed properties and not compete against buy and hold investors, but not so high that if the market starts to turn, they can get caught in a difficult spot. So that is very common advice, to be cautious if you're in the really higher priced markets. And that is generally where days on market will start to stretch out first. You'll start to see lower turn on inventory. And but we aren't seeing that at a profound level yet, but I do think that that's an accurate prediction, and that would be where there's going to be slowness first, right? Or slower from where we are today. I don't know if it's going to get to 6 months of inventory anytime soon, since we're so far below that, but that equilibrium point seems far away, but it would definitely hit there first. The other thing is that rising mortgage rates may force some buyers out of the market. And I do believe that that may happen to a certain extent, but the question is, are they going to go out of the market, or are they just going to go down in price point, right? Because if people are wanting to get out of apartments, or they're wanting to move to a different part of the country for some reason, or they have a new job opportunity, the question is, are they going to say, I'm going to be out of the market and just rent? Or are they going to say, I'm going to buy a $350,000 home instead of a $400,000 home, right? That may be the question that is to be asked as well. I don't know exactly. We're going to have to wait and see what happens. But I think that's another thing to consider, is that some people may not just buy as extravagant of a home as they could have whenever interest rates were 3%, right? And I'll go through all these, then I'll open it up for everybody. Home prices will keep going up, but growth will slow somewhat. We've been saying that for the better part of a year, probably, that the 20% appreciation, all-time high, that's just not sustainable over a long period of time, but that not necessarily depreciation in home values. Those are 2 very different things, right? A slowdown and a reversal are 2 very different things. And then number 4, some employees may face difficult decisions about returning to work in person, and that may impact their housing choices. We've seen a lot of people move to places that they could never have had the type of income that they have while working remotely. For example, a lot of people moving out of Silicon Valley to places that are far less expensive and still having those very high income tech jobs. We've seen quite a bit of that. The question is, how much of those people are going to be expected to go back, or are their employers going to say, you don't need to make quite as much because you're not living and paying for San Francisco home prices, right? So that's going to be a very interesting dynamic over time. It'll not only be difficult decisions for those people, it'll be interesting to see how companies react. Jennifer, any thoughts on this slide?
Yeah, a lot of thoughts. So the chief economist for the National Association of Realtors is predicting home prices to go up another 5% this year and then another 4% in 2023. So not nearly as fast as we've seen prices appreciate in the last 2 years, but that's still another 9% that prices are predicted to go up. I get a lot of calls from people who say, we're going to wait for prices to come back down. And I mean, there's no indication right now that is going to happen anytime soon. As far as interest rates, I did see a study that said buying the exact same home in 2021 versus this year in 2022 would cost you $200 more a month. And I think since interest rates have ticked up even a little bit more, that number might be a little bit higher. So when you look at people who think, well, I'm just going to keep renting, well, rents are also predicted to rise. And then I like to remind people the interest rate on rent is 100%. 5% doesn't seem so bad when you think about it that way. So it's really, you know, if you wait, you're going to be paying higher interest rates and definitely a higher price. So like everybody says, the best time to buy real estate was 10 years ago. The second best time is right now. I know it's a competitive market, but I do hope that it doesn't, that people don't stay out of the market just because of what's going on, because really long term, that's not going to be what's best for them. And then I do also, remote work has been a game changer. The fact that people are no longer tethered to an office, they can go live wherever they want, that we've seen a huge migration out to the suburbs. When I look at all the stats for the Houston area, the markets with the highest appreciation and the highest number of sales are our suburbs. So all those people that are no longer tied to their office downtown and can move out and get more house and have a yard and have a pool and maybe better schools. So that's definitely something that I think is here to stay and is going to affect the way that people choose where they want to live.
So do you think on number 4 with the return to work thing, do you think that that's kind of already played itself out and people have already moved, or do you think people will continue to move because maybe they say, hey, we're not going to go back to in the office type of deal? Like, you don't have to commute to downtown or the gallery or whatever. You can keep working from home. Do you think that's going to make it even more pronounced that people are going to move out? Or do you think you're going to have a return where people are say, okay, the pandemic's over, everyone come back to the office, so now more of the higher density type properties will go back up and it'll kind of have a reversal?
Possibly. I think we saw a big chunk of it play out over the last 2 years. What we are seeing employers do now is kind of switch to these more flexible work schedules where you're coming in the office, but maybe you're working like a 2-3. You're in the office 3 days a week and you're allowed to work from home 2 days a week. But people are still willing, if I only have to go in 3 days a week, I'm willing to drive a little bit farther and maybe get some more house. So I think it's still kind of shaking out, but like I said, it's not going away. The majority of companies that I've heard are not making everyone come back in full time. So I think we're going to see this more fluid, flexible type situation for people, and they can choose where they want to live based on what their company is doing.
Yeah, I've read an article in the Wall Street Journal talking about several New York investment banks and how every one of them was requiring people to go back into the office 100%, but all of them were giving some type of flexibility, like Jennifer just said. So I think it's going to be a hybrid work environment. So there's still going to be majority of people needing to go in, but that is going to change a lot of things. I think it's going to stabilize the commercial real estate market, but also people are going to have to make the evaluation that they can't just live in an entirely different city. That's not possible, as it has been for some people for quite a while. So that I do think that will evolve things over time. All right. Next slide.
All right, I'll read this one, then we can kind of open it up. So this is about inflation. So an article in the Wall Street Journal talking about interest rates versus inflation and kind of how that works out. So like I said, I'll just read the slide, and then we can talk about it. So mortgage rates are up to 5%, and some fear a valuation bubble. Even so, it's a good time to buy. A year ago, it was running at 2.6 on a year-over-year basis, March 20 to March 21. Today, this retrospective this is inflation. Annual inflation measures is 8.5. If inflation continues at this rate, you're better off borrowing money today at 5 and paying it back a year from now with dollars that had depreciated by 8.5%. Prices rose by 1.2% last month alone. That's an annualized inflation rate of 15.4. In that case, the current 5% mortgage rate is even more of a bargain in the short term. And then lastly, the market is figuring inflation at 4.9 over the year. That's still less than the prevailing 5% nominal interest rate. And there's a quote here from an economist. So we've never seen a time where mortgage rates have risen as quickly as they have, and the market hasn't cooled off. I don't expect the market to collapse by any means, but certainly it's going to go from gangbusters to one that hopefully looks more normal. So I think this is kind of what we've been talking about, how to combat this inflation, rates are going up. So while, yeah, you may not be happy about 5% because you could have got 4 last month or even better, it's all indicators are that it's going to keep going up significantly. And there were a lot of points, there's a lot of reasons the guy, the person who wrote this article had for why he thinks inflation will continue, even with increased interest rates. He pointed out 3 really good reasons, to him at least, as to why it still may not be enough to slow it down. So we could be in a significant inflationary year for sure, despite what the Fed's trying to do, which Wade said the other day, they talked about raising it 75 basis points at the next meeting, possibly, which is a move that I don't think I've ever heard of. Maybe it's happened before, but 75 basis points is a very extreme reaction to what's going on.
Yeah, I was going to say, I actually had a conversation with a potential borrower yesterday. He was frustrated with the increase in interest rates. And then I said, well, let's just do a comparison. What is the more relevant comparison, right? Is the more relevant comparison to what the situation of 6 months ago, or where we're going in the future? I think the more relevant comparison, because the only one that you can actually impact is comparing to the future. Comparing to the past, it's only going to frustrate you, and it's not viable. You can't go back in time. You can't go back and get that interest rate. You can't buy a home that was 10% less expensive 6 months ago, because that's what home prices appreciate. It's just not possible. Question is it better to buy a property to live in today, or is it better to invest in a property today than it will be a year from now or 2 years from now? So 2 things, I think rates are going to be higher than they are today. I think that's the consensus. And then home prices, very rarely is it projected to decrease. It is projected to slow, right? I think we saw, maybe we reviewed an article maybe a month or 2 ago where like 8 prognosticators, probably the biggest, like one had a slight decrease. Everyone else had anywhere from like a 5% to another 17% annual increase, So now that was before rates really started going up. So I think that 17%, probably no one is projecting that anymore. But at the end of the day, that is the realistic decision people have to make, is not having a recency bias and being frustrated about what they didn't get. It's really where you're going to go. Are you going to find a better investment than properties today? Are you going to find to live in or to invest in whenever they're going to be more expensive in the future and rates are probably going to be higher?
Yeah, I get the question a lot. Is this a bubble? Are we in a bubble? People are thinking that we're going to see another 2008 type crash. And what I remind them is that crash was driven by what was going on in the mortgage market at the time. This is a supply and demand issue. That's not something that is just going to fall off the edge anytime soon. That's something that's going to slowly balance itself out over time. So as far as a bubble, I agree with this quote here. I don't see that a crash coming anytime soon. But inflation is also really concerning to me, because not only are homes going up in value, interest rates going up, but the amount of money people are having to spend on other things, on gas and food and everything else, it's putting a squeeze on people. And I think what I'm hearing from all the conferences and things that I go to is I think what we're going to start seeing is some innovation in finance, the way that people may not keep doing the traditional 30-year loan. There's some shared appreciation models out there that could help you afford a higher price. Right now, power buyers, what we call power buyers, are starting to gain some traction, where they will help you make a cash offer on a home when it's competitive. So I think we're going to start to see, as prices go up and inflation really squeezes people, we're going to start to see somebody's going to come up with something to meet that consumer demand. And I know there's some mortgage companies out there that are already looking at some creative new ways of financing to help people get into homes despite the rising cost.
Yeah, you're talking about the bubble. And, you know, it being a mortgage related bubble last time, you know, people that were having a hard time, first of all, the credit was, it's not even close. I think I read something that said the average FICO today is like at an all-time high. You know, you pump so much money into the economy, give people a lot of cash because of COVID. They paid off their credit card debt or they have saved. So credit scores are way higher. DTIs, actually, I think they went up 1% lately, but debt to income ratios are very low. But I saw a stat from Texas A&M. They did like an annual report. It said the proportion of delinquent individuals at risk of foreclosure in Texas is 0.3%. So, and there's not a slew of these foreclosures. I mean, you know, when COVID hit, you'd hear a lot of people say, we're going to have this rash of foreclosures come across and it's going to kill the market, but there aren't any. That is, in my opinion, played itself out and we're back to normal.
I would add,
Yeah.
I would add to, oh, go ahead, Jennifer. I'm sorry, please.
No, sorry. I was going to say, there we go. I forgot the number now, but I heard a statistic recently of the number of people that went into forbearance that actually went into foreclosure, and it was very, very low. And part of that is because our market appreciated so quickly. If you had a home you needed to get out from under, you could get out from under it, and people gained such a huge chunk of equity that almost nobody had to go into foreclosure. So I second that. If you're waiting on foreclosures to come, you're going to be waiting a long time.
Two quick thoughts before we move to the next slide. You guys both said this in different ways, but the demand that was in place in 2006, 7, and 8 was an artificial demand because people that should have never bought homes or not bought homes as expensive as they purchased was created by the mortgage loans. People could use 125% loans for refis, for cash out refis. They were able to do loans with very low FICO scores and no money down, and just interest only loans that allowed them to afford homes that they would not be able to afford with a fully amortized payment. Like the alternative products were run amok, right? We're just not in that situation today. And back then, once you started to have that downward price pressure because it was artificial demand, then people could not get out of their homes because they did 125% mortgages. Like there were a ton of those, right? Or these other alternative programs. That's just not the case today. If someone is facing foreclosure, they'll just sell their home. It would take a lot of effort for them to be upside down on it. Not a lot of effort. It would take a lot of real price reduction for them to not be in a situation where they could just sell their home. And I think there's a long ways before that you look at that point, even whenever things were at the height, they still had much longer days on market and much greater inventory than we do today. So it's a very unique situation. Anyway, not to beat up this one slide too much, but we'll go on to the next one. What to expect in the 2022 spring housing market is told by 3 charts. This is in Fortune magazine. First one talking about the housing market coming off a year when U.S. home prices soared at unsustainable 18.8%. I think we're all in agreement with that. That's an all-time high. Odds of that happening again, very, very slim, especially with increasing interest rates. Almost impossible unless something really weird were to happen. When the pandemic struck, national real estate groups projected the housing market would enter a slump. And I think maybe whenever you didn't know exactly how bad the pandemic was going to be, that wasn't a horrible prediction. No one really knew how bad it was going to be, you know, how many people would be out of work, how severe things would be. So I don't know that that was an unrealistic prediction, but it just turned out that people were able to get back to work or work remotely a little bit more quickly than most people anticipated. So the shock to the economy, along with the injection of money to help those people who were more impacted, really made it not even just a non-issue, it made it a very highly appreciating market, right? Instead, by the summer of 2020, the housing market was booming as first-time millennial homebuyers moved into the market. And by the spring of 2021, housing inventory was down 32% from pre-pandemic levels. The housing market became frenzied in spring of 2021, and Zillow expects the year-over-year rate to peak at 21.6% in May and end the year at 17.3%.
Those are some big numbers.
Yeah, those are still really, really big numbers. That's Zillow prediction. I haven't seen as many of them that high recently, honestly. If I'm going to be honest, that's on the high end for sure. But you know, we're 4 months through the year, So we've already had a ton of appreciation. You know, we're still at 20%. Now, you'll see in a moment, Houston and some of the Texas areas are down a little bit from where they were earlier in the year. Not down in value, but down at the pace of appreciation. That's a very different thing. Slowing the pace of appreciation is entirely different than depreciating values. We all need to keep that in mind. Whenever we say it's unrealistic to stay at 18.8, that's true. People should not go into a panic because we're at 13 now. Like 13 is still double what it's historically been. But I do want to make one point on that. If inflation is 8.5%, and the historical appreciation rate for the last 2 decades has probably been 2 or 1.5, right? So that's 6.5% over the average. You have to add that on top of appreciation or take it from it to get to a realistic number. So if we're at 13%, we're really just on pace with where we've been historically with this massive increase in inflation. So you have to bake those numbers in, right? It's not like it's a true 15% if inflation is 8.5. That's something that I don't think a lot of people are really baking into the equation, but it has to be considered. Anything on this slide, Jennifer?
I think Austin is helping contribute to that 21.6%. They have seen a great, and I know we're going to talk about some different metro areas here a little bit later, but just speaking from personal experience, when the pandemic hit and we all fully went into lockdown, heck yeah, I had a lot of anxiety thinking, oh my gosh, I'm never going to sell a house again. If you had told me then we were going to enter into, you know, the strongest real estate market that I've been in the business 12 years. This is by far the strongest I've ever seen, but I hear from people who've been in a lot longer than me saying the exact same thing. None of us predicted it, but I do think it was a perfect storm of low interest rates, remote work, people now being free to move wherever they want to. People were trapped in their homes. So if you were not happy with your home, you now had nothing else to look at all day but your house, and realize you're working from your dining room table while your kids are homeschooling right next to you. Oh my gosh, we need space. So it was just kind of a perfect storm of events that created this incredible buyer demand. We had been underbuilding for a lot of years coming up to it. So when that demand hit, we just didn't have the supply to keep up. So I don't think any of us, if so, we all would have bought a lot of real estate back in 2020 if we had known what was coming. But this, what I'm seeing here, this feels right to me.
So this, we use this to give it a little bit of context, and I went on the St. Louis Fed website today, and I will say, in all honesty, that tail end of our chart needs to be extended a little bit because it's a little steeper. Because there's two things. Rates are over 5%, and I'm pretty sure it's the highest they've been in the past 10 or 12 years. Granted, but if you look beyond that, it's all relative. Like the difference between what it's at right now and the lowest, it's a couple points here and there. But if you go back just a little bit, not try to be so focused on the recent. Historically speaking, you can see how much it climbs or how much it can or did climb in other times, right? I mean, 5% now, people are complaining about 5%, but if you look at it historically, 5% is a pretty good rate throughout the last 50, I guess, 50 years. And I don't remember who it was or what I was reading, but they were talking about when we were at rates of inflation this high, with mortgage rates this low, it's almost unheard of. They're obviously rates are gonna continue to go up, in my opinion, but if you look at the inflation rate relative to what you're getting your money at right now, there's a mismatch there. So we always put this out there to kind of show where things have been in the past, where things are going. Like I said, we need to update our chart. It's a little steeper now, but it's still, in the grand scheme of things, money's still pretty cheap. Next slide. You're on mute. Wade, I think you're on mute.
Sorry, diving into Houston. We'll go over quite a few numbers. As we mentioned earlier, this is definitely an indication of a slowdown in the massive appreciation, but definitely not a slowdown or depreciation in prices. Single family home sales increased 4.1% year over year. So that's still an area that is growing, right? Days on market dropped from 46 to 38 year over year. Now, if you look at month over month, some of these numbers aren't quite as, the growth numbers aren't what they were, but year over year, it's still a significant growth. Top dollar volume increased by 15.7% to 4.6 billion. The single family median price increased 15.5% to 335,000, also a record, right? The single family average price rose 11.4% to 410, the highest of all time, and the first time of that price has topped 400,000. So that's a pretty big jump overall, right? And whenever you go through the numbers, kind of looking year over year, total active listings is still down year over year. So that means that there are fewer homes on the market than there were a year ago. That's still a very good indication of a tight market. And we're still selling more homes than we were at this time last year as well. So all those numbers are pretty interesting. Inventory is still 1.3 months. If you don't remember from our previous meetings or have heard about it, 6 months is equilibrium. So way below that, right? And pending sales is still in line with last year. So still a very robust market. And we have been showing this statistic for quite some time. If you look, the average rental was $2,075 last month. Pre-pandemic, it was $1,768. So you're talking about a significant increase over where we were before. That's over $300. The average landlord is probably pre-pandemic. They might have been making $300 or $400 per month in cash flow prior to that time. If they bought the home in the last few years, obviously greater if they bought it earlier than that. So that 300 does not sound that big relative to talking about a 2075 total rent. What it does sound really huge to is that it basically doubled a lot of people's cash flow in that time frame, right? So that is the power of real estate and how it can overcome inflation probably better than any other investment class. It's the most consistent asset class for investments whenever you do comparisons versus inflation in the previous high inflationary times.
So yeah, Jennifer, this is your baby right here. So to drop some knowledge on us. Do you have some thoughts on Houston and this chart?
Yeah, so we spend a lot of time talking about this. I will say we just crossed that $400,000 mark as far as average home price, and our phones started blowing up. It seemed like everybody in the country wanted to talk about the fact that the average home now was at $400,000. We've always been considered such an affordable state and such an affordable city. So yeah, that's a really big deal. A couple things, you're talking about the rental rates. I also own investment properties. I'm a huge believer in owning real estate and having real estate in your portfolio. I have one house that we sold in 2019 and I'm kicking myself now. I wish we had held on to that. Hindsight's 2020. But one thing that I like to point out is the common thing that I hear from people who are looking for investments, people who are looking for homes for themselves is there's nothing to buy. Look at the numbers there. We sold more homes in 2021, and we have than we have ever before. We have had record number of sales for 2 years in a row. That means more homes came on the market than ever before. They're just not staying on the market. They are going quickly. So you can get investment properties. You can get in a home for yourself. You just have to be ready to act quickly because that number, those days on market are still really low. That inventory is still 1.3 months, is way below a balanced market, but they are coming on. And I think that's the biggest misconception out there is there's nothing to buy. There's a lot to buy. You just have to have your game face on and be ready to go.
I was going to ask you, so you say people say there's no properties to buy, and I get that, and yet obviously the numbers are not the case, or not. That's not correct. So, what about like just the act of buying a home, like making offers, getting into bidding wars? Like is just because it's got to be a little different than say 10 years ago. If you're a buyer, whether it's for yourself or for an investment property, like are there some tips or strategies that maybe have evolved over the last couple of years that people should know?
So I know it's tough for investing. not a great time for real estate investors when you have a low inventory, quickly appreciating market. But some of the tips that we give people is, first of all, if you're a cash buyer, that puts you way out ahead of most people. So if you're an investor who can pay cash, or if you are partnering with one of these power buyers out there who will make a cash offer on your behalf, that right there really strengthens your offer. And now more than ever is the time to use a realtor. You need somebody whose full-time job is knowing the market, knowing how, if there's multiple offers, how high do we need to go, knowing different, that's not all about price. There's a lot of other terms in that contract that can be really attractive to a seller. So having somebody who can help you craft the most competitive offer, because I keep telling people it's not a crazy market, it's a competitive market. You just have to have a strategy and know what you're doing. And actually, out of all those, the highest number of sales, I think the number of what I saw, like FSBOs and sales that use non-realtors are actually at an all-time low. So we're in this, I think people are realizing the value of having an advisor, somebody who can help them in this really competitive market. So that would be my biggest piece of advice, is don't just do this on your own or think, well, I can save the seller a little bit of money if I don't have an agent. You have no idea what you're bidding against. And so you want somebody who is in this and is looking at offers and market data and stats and comps and coming soon properties every single day. That's really going to help you, give you the most competitive advantage.
So I Texas A&M put out a chart that I saw, and it had it's a percentage of, basically it's a ratio of sale price versus list price. And historically, it's in like the low to mid 90s, and it creeps up. And then right around 2021, mid 2021, it went over 1 for the first time that I can tell on this chart. Now, it never went over 1 for Houston. This was more so Dallas and Fort Worth. Austin went way over 1 for a little while. I mean, like it was like 110, I think. But even for as competitive as it is, it was never over 1 on the average for Houston. So that tells you can buy properties for, for what the list is for the most part, right? You may have some properties that get hot and you have bidding wars, but on average, you can get them for what they're listed at in Houston.
Yeah, I think one of the biggest things is people don't realize how area specific real estate is. So they hear these big nationwide stats or stats for the entire Houston area. Those are totally going to vary. You can have 2 neighborhoods right next to each other, and their list price to sales price ratio is going to vary. So you want somebody who knows that market and can say, hey, in this neighborhood you can do this, in this neighborhood you've got to do this.
Yeah,
that's a good point. Next slide. So San Antonio, kind of more of the same. The average, the number of sales are up slightly, just 1%. But if you look at the average price, it went from 314 all the way to 374. So I wouldn't be surprised if your counterparts in San Antonio are getting those calls when they go above 400,000 here quite pretty quickly, is my guess. Median price 326, it's up 22%. The one thing that we, as living in the investor space, I always look at the rents, and maybe you guys have some thoughts, but if you look at the average rent, a year ago it was $1,575. Now it's all the way up to $1,778. So that is a 13% jump. And while it's not Houston, which was 2075, I think, Houston was only going up, I think, like 6%. So the appreciation in the rents in San Antonio, it's closing the gap significantly. So I don't know if anybody has any ideas on why that is. I know that the prices in Houston are a little bit more expensive, so I'd expect the rents to follow, but they are narrowing the gap in that big rental space. San Antonio's, the prices are going up, and the rents are too. So it's still a good landlord spot.
Yeah, I think it's probably just getting to closer to where it should be, because the home price gap is not that significant. You're talking 410 versus 374, but the rent 1778 versus 2075. That's a bigger gap, right? So I think San Antonio should be coming up at a higher clip than Houston is, because rents seem lower in proportion to home values.
Yeah.
All right. Dallas. So it's interesting, if you look at home price appreciation over the last year, I was looking at this going between the charts. Houston is the lowest in the major metros. The other areas have more home price appreciation year over year, so that is interesting. Dallas here showing at 19%. Now, keep another thing in mind, this is the North Houston, so it's like the other areas we've been able to find more specific, like Houston itself, San Antonio itself, Austin itself. This is a broader group, but this is all of North Texas, including some rural areas that candidly are not included in the others. If this were not such a broad group, that median price would be significantly higher. But even with these less desirable rural areas, their appreciation is 19% year over year in this North Texas report. So that's really an impressive number. Market share, a lot of homes falling in this $200,000 to $300,000 range. Active listings are down there. If you remember, in Houston, listings were down slightly, 2.1%. They're down even more significantly in Dallas, so that's a tighter market. Also, months of inventory below Houston here, 1.1. Closed sales up slightly, and then the days on market number seems pretty in line with some of the other areas across Texas. And then we did find a statistic that was not reported exactly by this group, but the average rents were reported to be $22.10, which is a good bit higher than Houston and significantly higher than San Antonio, which is not unexpected because I do believe this median price and average price in Dallas would be higher than either one of those markets, for we're not such a broad geographic area.
Yeah, Dallas and Austin really seem to, as far as Texas goes, have seen the highest amount of activity and multiple offers. I think we're gonna talk about Austin next, but as far as home prices increasing, so a lot of people looking to move to that area. But I do think it's interesting, their closed sales are still up slightly. So just kind of goes back to, even with 1 month of inventory, that people are still putting their homes on the market. I think they're trying to take advantage of this. All the activity that's going on right now. If you're a seller, no reason to not take advantage of it.
Yep. So I'll cover this slide. You talked about Austin, how it just blows up the numbers. I mean, all of our numbers are, they're in the mid 3s and 4s. Their median price is $520, up 22%. The closed sales were down 5%. So, that's, I think the other markets were up, barely up, right? They're flat, or Houston was up 4%, but the other markets were flat. Austin was the first one that's down significantly. I think they're just running out of houses to sell, to be honest with you, over there. Average days on market, 21 days. That's 6 days fewer than it was last year. New listings are down. So this is the part, I don't know, I wish I would have done a little more research before the call. Active listings up 46%. That seems like an obscene number. It's not even close to the other numbers that we have on the other charts. Pending sales down 11%, and then months of inventory up 2.2 months. So I think that's 2 meetings in a row. Maybe they've gone up slightly. Obviously, still a ridiculously low amount of inventory, but I think it is. I guess it is going up slightly.
Yeah, it's going from thermonuclear to just nuclear.
Well, and I think part of the reason for Austin is you look at that median sales price. They have just seen such an increase in sales prices, with a lot of people coming from out of state, specifically California, people moving from higher price states and kind of importing their prices with them. And so I think that's why you're starting to see, because you notice that the sales are down, but the total dollar volume was up 10%. So even though they're selling less, the prices have just increased so much. Their volume is still really high.
Yeah. I'll cover this next one, Wade, so you can talk about the VRBO. This is the affordability index. We always add this in here, Jennifer. I don't know if you ever look at this or see it, but it's a measure of how much of if you take the average household that makes X dollars for the city relative to the average home price, how much of their income has to go to their mortgage payment, basically, is what this is a measure of. And so look at the top 5. I don't know how people can live in Miami or New York if 80% of your income is going to your mortgage payment, but you would expect to see cities like New York and LA. Austin's up there in the almost in the top 20. It's 21, right? And if you look the income, I don't see any income higher on this chart all the way till you get down to Plano. So while they do have high prices on their homes, the average income in Austin is much higher than it is in the other metros in Texas. See, I saw Houston. Dallas is crashing. I don't know what's going on, but they're getting a lot more affordable. Houston is ahead of, or I guess, ahead or behind, how you want to kind of position it. But Houston is 27th. Dallas is 30th on the affordability index. So I guess it's officially more affordable to live in Dallas than it is in Houston. And we just keep a couple of the other Texas markets on there. So, you know, as you can see, as you go down the list, the towns typically get smaller. But it's a good reminder of the value of investing in Texas still, even with increased prices. You look at a lot of those markets, you know, Houston's a major city. And they're, you know, to be 27th and be as large as we are, that's still pretty good.
Yeah, you look at the other top 10 cities with comparable amenities, and it's the price, the percentage of money you have to put towards your mortgage payment is not even comparable. So that's one thing to keep in mind when you're looking at national projections on where home prices are going to go. Markets are always very unique, and they all react differently. Back in 2007, 2008, 2009, while California, Florida, and other parts of the country dropped tremendously, Texas never really did, because it had always been a more steady growth pattern. And right now, you need to look at the migration numbers of where people are moving to which parts of the country, and there's a significant amount of people moving into this area, into Texas in general. And something that's not baked into this chart are state tax rates, and the fact that other things are more expensive as well, including gas and many of these other competing states where people are moving from. So a lot of reasons to feel pretty good about the Texas real estate. Before we move on to any questions, I did want to mention one other thing. I actually had a customer ask me yesterday, why will rates not go to 18% this time? And I do want to give some statistics that I think are pretty telling. Back in 1980, whenever rates went to 18 and 20% previously, our national debt was $908 billion, and it was 32% of GDP. That means with the GDP, the amount of gross domestic product in the entire United States, our national debt was only 32% of that. Move to today, our debt is 29 trillion, and it is 124% of our GDP. So our country is very comparable to your friend that has the great house and all the things, but they make less money than they actually have to pay out in debt, right? So that is where we are today. So why that impacts inflation and interest rates is that if we were to go to 20% interest rate, we would basically be increasing our tax bill so much that I don't think that is like, we couldn't come up with the money. So that's why we can't go to 18 to 20%. Can we go up a lot? Yes, but I don't anticipate rates going that high, which could trigger a real estate crash, but I just don't see how it's feasible to whenever your debt is 124% of your GDP versus 30% like it was back then. That's a massively different number, right? So I just thought that's one thing we had not covered in meetings in the past, but I did have a customer ask that yesterday when I was speaking with him, why not go to 20% again if inflation's so out of control? And that's, in my opinion, the biggest reason it probably will not happen. All right.
Next.
Great. So here's our program. It will definitely expand your universe of potential deals because you'll be able to afford more expensive properties. It'll allow you to diversify your portfolio. A lot of our borrowers thus far have really been in the long-term rental space, which is still a great space. We still really believe it's an excellent area to be in, but it is good to diversify your portfolio. Just like having a great stock. Everybody thought Netflix was a great stock. All of a sudden it's down 65%. So you want to have diversification in different categories. It's just important to do, right? The short-term rents, the property does not have to have been a previous rental. We can actually use short-term rents from other properties in that immediate area to help you get qualified to offset the payment, your principal, interest, taxes, and homeowners association due payments. We can offset that by neighboring rents and project what your rents will be on this particular property. It's going to be best in class pricing because you're doing conforming loans. That's always going to be the best in class pricing, but we think we're maybe the only or one of the only companies out there that's able to offer a program like this at the moment, where you can actually use a property that has never been a short-term rental in the past. You can capture more equity with less cash out of pocket. We're looking at some numbers, some modeling. You might be able to use a conventional loan max of, I think it's 647.2 on one of those programs that puts you into almost a $900,000 property. You'll get massive equity capture, hundreds of thousands of equity capture for maybe only 50 or 60% more out of pocket than you might be on a short-term, on a long-term rental, which is typically like a $250,000 home, maybe a $225,000 home. It's a real game-changing product, and we are able to, well, there's some data out there that shows that the average short-term rental at the moment is earning 61% more in revenue than the average long-term rental. So that's a huge difference in cash flow, big difference in equity capture. We think it can really help people have an outstanding new investment class in a time when people are really looking for that. That's it.
I want to do it now. Goodness. Like, I want to go find one. Gosh, 61% more. That's awesome. One thing I'd like to point out to people over the last 2 years is if you own a home, if you're not planning on moving, you have gained a huge chunk of equity. And I'm really trying to encourage people to use that for something. You can take that equity out and then put it into a short-term rental. And another thing that I think a lot of people is attracting a lot of people to these is kind of back to the remote work thing. If you can work for a month in, on a lake somewhere or in the mountains in an Airbnb, why not? If your kids can do school online, if you can work online, people are picking up and moving. And some of the people I know that have bought Airbnbs or short-term rentals over the last year, they also get to use them. So they can go stay in that house for a month, and then when they're not using it, they have people renting it out. So this is awesome. I want to do it.
Awesome. All right. Yes. Sorry, Wade, were you going to add something?
I was just going to say, see if we had any questions after we show everyone Jennifer's contact info.
We do. And before we move on to questions, I do want to just let everyone know again that we are recording this webinar. I saw a few of you ask, so you will receive a copy of it. Jennifer's information is on the screen. And as always, one lucky winner will receive half off their hard money processing fee. The lucky winner today is Sean, and I apologize if I butcher your last name, Armistead. Congratulations. You will get an email, and we will connect you with one of our fully licensed loan officers to go over any additional details or questions you may have. Next, I will jump into questions, and the first one was actually asked much earlier in the presentation, but happens to transition so perfectly from our last slide. What makes Airbnb investing and lending any different from other investment options?
I'll let well, first I'll say the investment category, the biggest difference is that there are no long-term leases, right? It's all short-term. People do pay significantly more, but there's usually more vacancy. But it's not significantly different. You can still use a property management company. They charge more because it's a much more active type of property management, but you can do it in a very passive way. So those are the differences. I will say that
they asked earlier, so I think that 61% is probably one of the biggest differences on cash flow. Sure,
and I think that those numbers are also noisy because there's just typically homes are a lot more VRBO, short-term rental type homes are normally more expensive. So I think those noises are number, and candidly, it could be even greater. We know people who have converted properties that were long-term rentals in the past into short-term rentals, and the numbers have increased by far more than 61%, far more. So I think that's kind of like a really big, broad average. As far as lending, one of the toughest things for people in the past has been how do I have the ability to buy these properties without just qualifying based on my own personal income? So why this is a game-changing product is that we are able to use short-term rents to offset those payments and allow people to get into more expensive homes. So that's really a big difference because in the past, you would have to maybe use a non-qualified mortgage, but then you have to have the appropriate debt service coverage ratio. And in order to get that, you have to use long-term rents, and long-term rents are just not as high as short-term rents, right? So that's been a real complexity for people. There, we do have one product where there was no DSCR and no personal income requirement, but the maximum LTV we could go to was 70%. So it's a very big deal to be able to go to 75, and candidly on a purchase we could go to 80. But then the other thing is that you're just going to be able to get into much higher price points because the pricing is going to be better than those non-qualified mortgages as well. So it's a big advantages in many categories.
Awesome, thanks, Wade. My next question is for you, Jennifer. They are asking, is there one area or segment in Houston that seems to be particularly hot?
Yeah, so the suburbs in general are seeing a lot of activity. I happen to live in the Katy market, and every month we have MLS stats that come out. We kind of call it a hotness ratio, which markets are the hottest, and actually for the last 2 months it's been Katy. So I think, again, you're just seeing that migration, people who are wanting more space, good schools, more house for less money, and they have more flexibility now due to their jobs and being able to work remotely part of the time. So for the most part, if you look at from the north, west, all the way down to the south, not quite southeast, that band of Houston, the outer suburbs, is what has seen the most amount of growth in the last 12 months.
Awesome, thank you, Jennifer. This question has a little bit of a comment towards it, so I'm going to read the entirety, and it was earlier on, so. And Stephen, if you're still on the call, it looks like you are. If I'm not asking your question properly, please write in and I'll be sure to ask it. I will read what was written. Another solid strategy that has been super helpful, approaching seller agents and telling them they can represent me, dual agency agreement, which strengthens my offer since the agent will get 5 to 6% of the listing price. Is that right? So I think maybe they're trying to share their strategy and get your feedback, Jennifer. It was about the time that you were speaking.
Sure. Not sure exactly, which market he is in. In Texas, we don't have dual agency, so you would have to. It would be more of an intermediary type situation. I've seen people on listings make offers with an agent, without an agent. People who write letters, the love letters. And what I see typically is people are going to go with the offer that nets them the most money. It's just, at the end of the day, it is what it is. Even if your family really loves it, or you're offering to not use an agent to represent you, all those kind of terms, if the net is not going to be the best for the seller, then typically your offer is not going to get chosen. So I do recommend making sure that all the terms of your offer are really strong.
Awesome. Well, that's cool. I didn't know I've never heard of dual agency, but probably because I live in Texas. So now we know that that's not even an option in Texas. That's pretty neat. That's good information. Our next question, this one might be for you, Jeff. What state is the short-term rental conventional loan available?
Short-term rental in all states.
It is available in all states. Okay, great.
Yeah.
Awesome. So that's for that Airbnb. Nice. Guys, jump on that. Let me take a peek at this. This is a little long. Actually, while I check this one out, there's a shorter one, so I'll read this one to you. If you currently have any rental properties, how can you capture the equity and use it for buying other rentals or buying properties for VRBO?
How can you capture it?
Yeah, this one says, if you currently have rental properties, how can you capture the equity and use it for buying other rentals or buying properties for VRBO?
You could sell or refinance. A lot of people, they don't want to sell them because they're cash flowing, and it's a appreciating asset, so most people don't want to sell. But you could refinance, and with as much equity as been gained over the last 2, 3, 4 years, you probably have quite a bit that you could pull out, pull cash out, use, depending on how much equity you have, you could use that cash to buy 1, 2, 3 more properties. It just depends on the size of the equity you have and the deals you find. But a lot of people are doing that, just doing cash outs to, like Jennifer said, do a cash out and then go buy another property with it, or 2.
Awesome, thank you, Jeff. And if you guys have more, feel free to write in. This question does reference Louisiana, and I know that is not our primary market, but maybe Wade, you'll take this one because that's your home, where you're from, hometown. So this question is, what are your thoughts on the state of homeowners insurance as a looming drag on the market? Here in New Orleans, FEMA 2.0 and the large amount of insurable disasters occurring are causing insurancers to exit and premium hikes may continue. I'm trying to predict if it's worth 1031ing my portfolio away from the Gulf Coast.
So I'm not from New Orleans. I'm actually from a small town, Louisiana, but I know a little bit about it. I don't think that even with, I mean, the flood insurance rates have gone up as they probably should, but I think that comparatively to other parts of the country, I don't know that it's out of line in many markets. I think it's just a cost you have to bake in, right? I mean, if you're talking about investing in other parts of the country, some parts of the country, it's impossible to be a single family buy and hold investor because you can't get the rents to cover what the prices are. So you just have to bake it in. It's cost of doing business. It is a variable cost. If you have a mortgage payment, that's locked in. Flood insurance is variable and somewhat unpredictable. So that's something you have to keep in mind. But I mean, I think having some diversification is always important. So if you wanted to own some properties in other areas, either passively or actively, that may not be a bad idea.
Awesome, thank you, Wade. Okay, and it looks like this is our last question. Jennifer, I believe it's for you. Oh, Jiminy Crickets, one just came in. We have two more. We're just after time, and I know Wade has another call, so we will try to get through these. If you guys have additional questions, please reach out to us. Our contact information is on the screen, so we'll reach out to you after. Jennifer, this question is, any thoughts on the Huntsville market or Livingston?
So north of our area, so I can't speak to it really specifically, but what kind of, I don't want to repeat what we've already said, but again, people having more flexibility where they are moving to lower priced markets. They are, a lot of them looking to get out of the city. And so I think kind of all these, I don't want to call it a small market, but smaller markets, I think are seeing a bit of a boon from the people who are tired of the prices and the taxes and the traffic and everything that comes with living in a large city. So I can't speak to it specifically, but if I had to bet, I bet things are going well there.
Yeah, we're doing a lot more deals in markets like that than we did in the past. Better deals too. Lower out of pocket typically.
Awesome. Okay, we had a few questions come in. Guys, I've written your names down. We'll reach out to you. I'll ask one more just because it came in before I had the cutoff. This question is also regarding Airbnb. I've heard that most of Houston is good for Airbnb. However, does location play a big part in running a successful Airbnb? Being close to downtown, question mark, the airport, question mark.
I would say definitely. You know, if you're trying to think of where are people going to want to go and stay short term, so maybe the med center. You have somebody who, you know, has a family member who's undergoing treatment and they don't want to stay in a hotel for a month. So keep in mind what's close by. But it's surprising to me how there are Airbnbs in all parts of the city. I live in Katy, and why would anybody want an Airbnb here in Katy? There are Airbnbs out here, and they do get rented. So, but I would definitely keep in mind what it's closest to and what your renter is most likely going to be using it for. What are they going to want? Consider that when you're making your offers.
Yeah, Jennifer, good point. I can't remember why or even when, but sometime in the last year, I thought I'll go to Seabrook. I had to go for something. I was gonna be there all day, and I thought I'll just get an Airbnb and stay the night. And I was shocked to see how expensive they were in Seabrook. I'm like, Seabrook, Texas? People really even want to be here, and they're charging this much for the Airbnb? It's cheaper to go to a hotel. But it was kind of just funny. I'm like, well, I guess people do come out here and they'll rent the whole house and they'll be by the water. And to me, that wasn't an area that I had considered would be like a vacation spot. But I guess if you are on the other side of town and you want to, you know, everybody has different needs, but definitely having some sort of attraction or something nearby will always help you sell a little bit more. But awesome, Jennifer, it was fabulous having you on this webinar today. We are so grateful for you sharing your insights. Jeff, Wade, everybody has such a good time. We've gotten feedback right now saying thank you so much. So guys, again, if you have any questions, please reach out to us. Our contact information is on the screen, and we will see you next month.
Thank you, Jennifer.
Thanks, everybody. Thanks, Jennifer.
For having me. Thank you.
All right, bye-bye.